In 2008, the global financial system came dangerously close to total collapse. Banks failed, stock markets crashed, millions lost their homes and jobs, and governments around the world had to step in to prevent a complete meltdown. But here's the real question. What actually caused it? Was it greedy bankers, careless investors, or a broken system? And what can you, as a modern investor, learn from this crisis to avoid the same mistakes in the future? Hello, and welcome to Evelyn Kingsley Finance. I'm Evelyn, and I'm so glad you're here. Today, we're going to talk about one of the most dramatic events in modern financial history, the 2008 financial crisis. We'll explore how it happened, why it shook the entire world, and, most importantly, what lessons investors can take away from it today. Before we begin, remember, this video is for educational purposes only and is not financial advice. Now, let's get started. To truly understand the 2008 financial crisis, we first need to look at the world in the years leading up to it. The early 2000s were a period of optimism and growth. Interest rates were low, credit was easy to access, and the housing market was booming. Owning a home wasn't just a dream, it was something almost everyone believed they could achieve. Banks were eager to lend, home prices kept climbing, and people felt wealthier than ever. If you bought a house, chances were its value would rise quickly. Many believed the housing market could only go up. This optimism created a sense of financial security, and borrowing didn't feel risky. It felt normal. Meanwhile, Wall Street was thriving. Investment banks were creating complex financial products. Global markets were strong, and investors around the world were pouring money into U.S. assets. On the surface, it seemed like the perfect environment. Jobs were stable, markets were growing, and the future looked bright. But underneath the surface, cracks were forming. Debt levels were rising, lending standards were falling, and the financial system was becoming more fragile. Few realized it at the time, but the foundation was shaky. This was the world before 2008, confident, booming, and completely unaware of the storm that was about to hit. Next, we'll dive into the spark that lit the fire, the housing boom, and how cheap credit fueled one of the biggest bubbles in history. The housing boom of the early 2000s seemed unstoppable. After the dot-com crash in 2000 and the tragic events of 9/11, the U.S. economy needed a boost. To stimulate growth, the Federal Reserve cut interest rates to historic lows. Suddenly, borrowing money was cheaper than ever. For millions of Americans, this meant one thing: buying a house became easier. Banks and lenders were handing out mortgages with low initial payments and attractive terms. Even people with poor credit histories, who previously would have been denied, were now able to qualify for loans. As more people rushed to buy homes, demand soared, and with rising demand came rising prices. Home values began climbing year after year, and soon, real estate was seen as a can't-lose investment. Many believed houses would always go up in value, no matter what. But it didn't stop there. Homeowners began taking out second mortgages or refinancing their properties to pull out cash. They used this money for renovations, vacations, or even to buy more homes. Real estate wasn't just shelter. It had become a way to get rich. At the same time, developers were building more and more houses to keep up with the frenzy. Entire neighborhoods popped up almost overnight. It looked like endless growth, but in reality, it was a bubble inflating. What most people didn't realize was that this boom was built on fragile foundations, risky lending, rising debt, and unrealistic expectations. Next, we'll zoom in on the root of the problem: subprime mortgages and why they became the ticking time bomb of the financial crisis. At the heart of the 2008 crisis was something called the subprime mortgage. To understand it, let's break it down simply. A prime borrower is someone with good credit, stable income, and a strong history of paying debts on time. A subprime borrower is the opposite: someone with poor credit, unstable income, or a higher risk of default. Traditionally, banks avoided lending to subprime borrowers because the risk was too high. But during the housing boom, things changed. With low interest rates and high demand for mortgages, lenders saw an opportunity. They began offering loans to people who normally wouldn't qualify. And these weren't just normal loans. They were often adjustable rate rate mortgages, ARMs. These loans started with low teaser interest rates, making monthly payments affordable at first. But after a few years, the rates reset much higher, suddenly making payments unaffordable. Why would banks do this? Because they believed housing prices would always rise. If a borrower defaulted, the bank could simply repossess the house and sell it for a profit. On paper, it seemed like a win-win. But here's the problem. Millions of these risky loans were being handed out, and many borrowers never fully understood the terms. They were promised home ownership, but what they really got was a ticking time bomb. As long as housing prices kept climbing, the system worked. But when prices began to level off and later fall, borrowers couldn't refinance, couldn't keep up with payments, and defaults started piling up. Next, we'll see how Wall Street took these risky loans, bundled them into complex financial products, and spread the danger across the entire global economy. If subprime mortgages were the spark, Wall Street was the gasoline that turned it into a global fire. Banks weren't just issuing risky loans, they were packaging them into financial products that spread across the entire world. Here's how it worked. Thousands of mortgages, good, bad, and ugly, were bundled together into something called mortgage-backed securities, MBS. Investors bought these securities because they were promised steady returns, and since they were backed by real estate, many believed they were safe. But Wall Street didn't stop there. They created even more complex products, like collateralized debt obligations, CDOs. These took slices of different mortgage bundles and repackaged them into layers, some safe, some risky. Rating agencies often stamped these products with high ratings, like AAA, which gave investors false confidence. Why was this so dangerous? Because risk was being hidden, not eliminated. Investors, from pension funds to international banks, were buying what they thought were stable investments, but in reality, they were filled with toxic subprime mortgages. To make things worse, big banks and hedge funds began betting on these products using derivatives like credit default swaps, CDS. It became a massive, tangled web of risk, with trillions of dollars at stake. When borrowers started defaulting, the entire system unraveled. The securities lost value, the banks holding them suffered huge losses, and because these products were everywhere, the pain spread globally. In the next section, we'll look at the breaking point, the crash of 2008, the collapse of Lehman Brothers, and how panic swept through global markets. By 2007, warning signs were everywhere. Housing prices stopped rising. Borrowers began defaulting on subprime mortgages, and suddenly those safe mortgage-backed securities were looking very unsafe. In September 2008, the crisis reached its breaking point. Lehman Brothers, one of the largest investment banks in the world, collapsed under the weight of toxic assets it could no longer sell or value. Its bankruptcy, the largest in U.S. history, sent shockwaves through the global financial system. Markets panicked. Banks stopped trusting each other, refusing to lend money even for short-term needs. Credit markets froze, and without credit, businesses couldn't operate as usual. Stock markets around the world plummeted, wiping out trillions of dollars in wealth in just weeks. Ordinary people felt the impact immediately. Retirement accounts shrank, housing values crashed, and millions of jobs were suddenly at risk. The fear was so intense that some experts genuinely worried the entire global financial system might collapse. Lehman's fall wasn't just about one bank. It symbolized the failure of an entire system built on excessive risk and blind confidence. Other financial giants like AIG, Merrill Lynch, and Bear Stearns faced their own crises, and governments scrambled to decide who to save and who to let fail. It was chaos, and it showed just how interconnected the world's financial system had become. Next, we'll step away from Wall Street and look at the human cost of the crisis, lost jobs, foreclosures, and the struggles that millions of families faced in the aftermath. While headlines focused on banks and markets, the real tragedy of the 2008 crisis was the human cost. Behind every foreclosure and every job loss was a family struggling to survive. As the housing bubble burst, millions of Americans lost their homes. Foreclosure signs lined neighborhoods, and families who once believed they had achieved the dream of homeownership suddenly found themselves evicted. Entire communities were hollowed out, with abandoned houses serving as reminders of broken promises. The job market collapsed too. At its peak, the U.S. unemployment rate soared to 10%, the highest in decades. People who had stable jobs for years were suddenly without income, and recent graduates faced the toughest job market in a generation. Globally, millions more felt the ripple effects as economies slowed, businesses shut down, and international trade declined. Retirement savings and investments were also devastated. Ordinary workers saw their 401ks or pension funds lose 30 to 40% of their value almost overnight. Dreams of retirement had to be postponed, and for many, the losses were permanent. Beyond the numbers, the crisis left deep emotional scars, stress, anxiety, and a loss of trust in financial institutions. People realized that the system they believed was safe and stable could collapse almost overnight. Next, we'll look at how governments around the world responded. The bailouts, stimulus packages, and regulations that tried to stop the bleeding and restore confidence. When the financial system stood on the edge of collapse, governments and central banks around the world had a choice: act quickly or risk a complete economic meltdown. In the United States, this meant stepping in with unprecedented measures. One of the most controversial actions was the bank bailouts. Through programs like the Troubled Asset Relief Program, TARP, the U.S. government committed hundreds of billions of dollars to stabilize major banks, insurance companies, and even automakers. The goal wasn't to reward bad behavior. It was to prevent the domino effect of more failures that could destroy the global economy. The Federal Reserve also slashed interest rates to near zero and began pumping money into the financial system through quantitative easing. This meant buying government bonds and mortgage-backed securities to keep credit flowing. Without these steps, businesses and consumers would have been unable to borrow, and the crisis could have deepened into a full depression. Worldwide, other governments followed with their own stimulus packages. From Europe to Asia, trillions were injected into economies to restore confidence, protect jobs, and encourage growth. At the same time, new regulations were introduced to prevent another crisis. Laws like the Dodd-Frank Act in the U.S. imposed stricter rules on banks, required more transparency, and aimed to reduce risky behavior. These measures weren't perfect, and they remain debated to this day. But without them, the 2008 crisis could have been far worse, and recovery might never have happened. Next, we'll step back and focus on what matters most for us as individuals: the key lessons that investors can learn from the 2008 financial crisis. The 2008 financial crisis wasn't just a failure of banks and governments, it was also a reminder of how human behavior shapes markets. For investors, the lessons are powerful and timeless. The first lesson is about leverage. In simple terms, leverage means borrowing money to invest. It can multiply gains, but it can also multiply losses. In the years before the crisis, banks, investors, and even homeowners relied heavily on leverage, believing housing prices would rise forever. When the market turned, debt magnified the damage. The takeaway? Be careful with borrowing. If your investments rely too much on debt, you're taking on more risk than you realize. The second lesson is about greed and fear. These two emotions drive markets more than anything else. In the boom years, greed convinced people that risk didn't matter. In the crash, fear caused panic selling that made losses even worse. As an investor, learning to control your emotions is just as important as picking the right assets. Another key lesson is the importance of diversification. Many people had all their wealth tied up in real estate or a single investment. When that one asset collapsed, they lost everything. Diversifying across different asset classes, stocks, bonds, real estate, and even cash helps protect against shocks. Finally, remember that if something sounds too good to be true, it probably is. Easy profits and guaranteed investments should always be a red flag. Next, we'll look at how the markets eventually recovered and how some investors who stayed disciplined turned the crisis into an opportunity. At the height of the 2008 crisis, it felt like the financial system might never recover. Stock markets were down by more than 50%, unemployment was soaring, and fear was everywhere. But history shows us something important. Markets do recover, and often stronger than before. In the years following the crash, governments and central banks kept pumping liquidity into the economy, and slowly, confidence returned. By 2009, the U.S. stock market began to rebound. Over the next decade, it entered one of the longest bull markets in history, turning what seemed like financial ruin into massive opportunities for long-term investors. Real estate markets eventually stabilized too. Housing prices that had collapsed in many cities gradually recovered as supply and demand balanced out. Homeownership became more cautious, but also more sustainable. For investors, the recovery highlighted a timeless truth. Those who stayed patient and disciplined were rewarded. While panic selling locked in huge losses for many, those who held on, or even bought more during the downturn, saw significant gains as markets bounced back. The crisis also spurred innovation. Financial technology, stricter banking regulations, and new investment products emerged from the lessons learned. The system became more resilient, and investors became more aware of the importance of risk management. The big takeaway? Every crisis, no matter how devastating, eventually creates opportunities. The key is not to panic, but to stay focused on the long game. Next, we'll bring everything together and close with the most important message: how to prepare yourself for the next financial storm. The 2008 financial crisis was a painful reminder that markets can crash, bubbles can burst, and entire systems can shake overnight. But it also taught us invaluable lessons that every investor should remember. First, no market goes up forever. Just because an asset is booming doesn't mean it's safe. Housing, stocks, crypto, history shows that anything can fall if it grows too quickly without fundamentals. Second, risk management is everything. Don't put all your wealth in one place. Diversify your investments, keep a cash cushion, and avoid relying too heavily on debt. Protection matters just as much as growth. Third, emotions can be your worst enemy. Greed makes you buy at the top, and fear makes you sell at the bottom. Staying calm, patient, and disciplined is one of the most powerful skills any investor can develop. And finally, remember that crises also bring opportunity. Some of the greatest fortunes in history were built by those who stayed strong, invested wisely, and focused on the long game while others panicked. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and share so others can learn these lessons too. The truth is, another crisis will come one day. We may not know when or what will cause it, but if you take the lessons of 2008 to heart, you'll be far better prepared, not just to survive it, but to come out stronger on the other side.